The information contained in this podcast is an expression of opinion and does not constitute investment advice. This is the Gold Money Foundation podcast with Alasdair Macleod, keeping you up to date with expert opinion on precious metals and the markets.
Hello, I'm Alasdair Macleod, and I'm here on behalf of the Gold Money Foundation. And with me I have Detlev Schlichter, who has written a very interesting book called Paper Money Collapse. Welcome, Detlev. It's very nice to have you here.
It's my pleasure, thank you.
I read your book with great interest, and I must say that I agreed a lot with what you said, almost entirely with what you said. The conclusion is, it seems to me, one that I agree with, and that is you've got the potential, I think, for crisis first at the end of the day and solution second, as being the ultimate outcome of our paper money. Is that how you see it?
Yes, absolutely. I think what I show with my book is that we cannot really make a fundamental economic case in favor of paper money, of fiat money. And the way I characterize fiat money and distinguish it from commodity money, traditional forms of money like a gold standard, is that in one system, the fiat money system, the supply of money is essentially elastic, and in a commodity money system like a gold standard, the supply of money is inelastic. And what I try to show with my book is that, based on thorough fundamental economic analysis, you can show that elastic forms of money must over time lead to economic imbalances that get ever bigger, that accumulate over time and completely destabilize the system. And I think we've reached such a point now in our system. I think there are two options now, two possibilities how we can deal with the present crisis, which I consider to be a fiat money crisis. Either, we stop voluntarily, or monetary authorities stop voluntarily printing money and allowing the market to set interest rates, thereby allowing the market to also cleanse the system of accumulated imbalances. So we have to go through a crisis, but one that cleanses the system. Or we don't do this because it's politically not deemed acceptable, and we then have to print ever more money, ever faster, which is what we're doing right now and what I think will continue. But that then also means that we even get a larger crisis at the end of it. So whichever way you look at it, I think a crisis is a certainty. The question is a bad crisis sooner, or an even worse crisis later, although we can argue now how much later that is really going to be because we're running out of time. But I think you're right. That my hope is very low that we will see any political initiative here, any end to money printing, and any end to fiat money expansion.
Of course, what the politicians will do is, in the past, they've been very successful at buying off the inevitable, and they're going to continue to do the same, I suppose. Kicking the can down the road is the other way of putting it. But I think what we have seen, and particularly with the banking crisis in 2007-8, was the end of an accumulation of credit-driven cycles, which just got more and more out of control. And your book has a very interesting section on, the effect of paper money and credit on the underlying economy. Would you agree with me that in effect we have reached that end point and there has been a fundamental change in behavior, which perhaps means that's why interest rates are having very, very little effect in getting the economy going, because everybody's become risk averse now. It's almost as if we're in a new phase with a larger cycle. I mean, how do you see it?
Yes, I think you're right. I think we've reached an important point, and the way I see it is we've reached the point where the private sector is no longer playing along. So in this game of kicking the can down the road, policymakers are constantly relying on somebody in the economy extending their balance sheet. That is the underlying idea of the paper money system. You lower interest rates again and again. Whenever the system wants to correct, you provide fresh bank reserves, encourage extra lending, low interest rates. But that always requires that somebody extends his or her balance sheet and that we take on more debt. And I think you're right. I think behavior has now changed. I think the private sector cannot be fooled into believing that sort of these easy money cycles can be extended forever. And I think it will be difficult to ignite another real estate boom, for example, because the memories are just too fresh. I mean, people learned their lesson; they got burned. Whether it's the Nasdaq bubble, whether it's the mortgage and real estate bubble, and so that's why I think it's very rational that people now keep leverage low and that the private sector is no longer engaged in another round of easing. I think from that aspect alone, you could even argue there are now some sort of deflationary forces in the economy, because there are tendencies to not take on the cheap money, not to extend the balance sheet, maybe even to clean up the balance sheet. But I think what we see is that in their desperation, policymakers now want to push it out further, and what happens is we have the central bank as the lender of last resort, and now the government as the borrower of last resort. So what we see is now the cheap money from the central bank now gets channeled directly into government spending, either directly or via the banking system. And I call that in my book, I call it the nationalization of money and credit. So in a way, you can circumpass to some extent, you can go around the private sector. And I think we see a lot of that happening right now.
Absolutely. And the other thing that's happened over time, of course, is the destruction of savings. And not only do we now see that governments monopolize savings for their own spending, but zero interest rates with 2% yield, while inflation is running at 4% officially, probably 5, 7, 8% unofficially. That can't go on for long, can it?
No, I think it cannot, and I think we now also reached the point where I think parts of the private sector, or more people in the private sector, are looking through this, charade. It gets ever more difficult for the central banks to argue that they simply set these interest rates and that they supply all this liquidity because they want to stimulate aggregate demand, which always makes it sound like this is something that helps all of us. We should all be cheering for these zero interest rates. It's all a policy that's being done for all of us, when we really know is being done is a way to bail out the banks.
It's certainly not helping the savers.
No, exactly right. And so people who saved, who didn't borrow, who didn't even participate in the bubble economy that went bust in 2007, these people are now even being punished in seeing their savings go. So obviously the whole thing is, I think, for lack of a better word, unethical. It's a further distortion of the market. It discourages savings, which is really what we need. I mean, I think the one thing that every capitalist society is based on is savings. Savings means you consume less than you produce, you save the difference, and you invest it. You defer your consumption, and that's the basis of a true capital stock. That is how capitalism works. And again, it's being undermined. And it further goes to show that a paper money system, and the more extreme it gets, is not compatible with a free market system and functioning capitalism.
And another point which you bring out, I think, very well in your book, is the fact that when money is actually injected into the system, either by government spending or by central bank producing or by banks expanding credit, it doesn't go into the economy evenly. Some people get it first and they get the benefit. And the last people get it find that by then the prices have already risen and they have problems. So it is a very, very unfair system. There is the idea that you can somehow stimulate the economy by printing money. There are losers who are never considered. And I think that's something that you bring out very well in your book.
I'm glad you brought up the point, because I do think it's such an important point of our money creation process and of our current system. It really makes me sometimes angry, sort of, when I read in the mainstream media and stuff. You hear it on TV, you see it on TV and hear it on radio. It's all these arguments about that this is a policy, easy monetary policy that we all should be grateful for. And obviously, I'm anti-fiat money and paper money, so I would argue for an apolitical monetary system, like a proper gold standard. And the counter-argument is often, well, we couldn't stimulate the economy. And I think you make a very important point here. Whenever the central banks issues money and injects money into financial markets, it's entirely impossible for everybody, for that money to reach everybody at the same time. So I think the way it's being described often gives the impression of the central bank is just adding liquidity or a stimulus, which almost sounds a bit like the central bank would put a little bit of oil or grease into the economic machinery, just make it operate more smoothly, not change the way it operates. That's entirely impossible. Injecting money, fiat money, into the economy via the banking system must change economic processes. It will change resource allocation. It will change income distribution. The money will reach certain individuals and certain parts of the economy and sectors of the economy sooner than others. Some will simply be left to suffer the inflationary consequences, the price effects, while others get the money early and can spend the extra money income before prices throughout the economy have risen. So it is always a distortion of the market economy. It's always a reallocation of resources. It's a redirection of economic activity. It is a full-fledged market intervention. It's not just adding oil, making the machinery operate more smoothly. It's a fundamental, it affects many people in very fundamental ways.
It's rather like adding burning oil onto the surface
exactly,
of the water. Yeah. The one thing that the central bankers, I believe, are more terrified of than anything else is an Irving Fisher-style debt deflation collapse. And this seems to be spurring them to produce as much raw money as possible whenever it is needed in order to counteract what they perceive as contracting bank credit. Have you any comments on that? Do you find that that's, from your connections in the banking system, that this is the case, or?
Yeah, no, I think that is the case. I do think there is this immense fear of deflation and credit contraction. What surprises me is a little bit that this seems to be a very short-sighted way of looking at things. It's not really thought through completely, because the problems we have right now are to a large degree problems because we have accumulated too much debt, and we have accumulated too much debt because a constant expansion of the money supply will over time leave us with too much debt. So the problems we face now globally, which is sort of weak banks, distorted asset markets, and too much debt, are all the result of the ongoing decades-old process of paper money expansion. And you're right. Right now, the fear is this should not be allowed to correct. But if you don't correct it, you cannot solve the problem. If there is too much debt, how can you get rid of it? And stimulating the economy with low interest rates and with quantitative easing means, again, that you are taking on more debt. I mean, we've seen now in the 3 years that we've conducted, more than 3 years now, quantitative easing in the United States and in Britain, debt levels are not coming down, and the government is taking on ever more debt. So the idea that you have a correction, a credit contraction, and a cleansing of the system of excess debt, but at the same time you run a zero interest rate policy and push more money into the economy, there's a complete contradiction here. So what they're doing is they're fighting the symptoms, and they're making the problem of their own making, they make that problem even worse.
Absolutely. And of course Europe has got a different set of problems with the slow motion collapse, if you like. I think mostly of the political system. With the ECB trying very hard to keep the banking system going, do you reckon they'll succeed?
Well, obviously, I mean, my outlook is for an intensifying fiat money crisis globally.
So they're going to have to print more and more in order to
exactly. So I think what the end game I envision is that all central banks and the ECB, but others as well, will continue to print ever more money. And that ultimately this will undermine confidence in the system, and it will end as all fiat money systems have ultimately ended. In that sense, I do not think, so the question, can they stop a bank collapse? I think right now they will do everything they can to keep the banking system going, which necessitates that they keep on printing money, as they've done in recent weeks. I mean, the ECB obviously injected now a total of a bit more than €1 trillion within a matter of 2 or 3 months into the banking system. I think that goes to show how weak the banking system is. This is not a reason for optimism. This is a reason of concern if the banking system needs that much cheap money. My outlook is, I think most likely they will continue to do this. I think they will also continue to buy certain sovereign bonds. So I think, again, the printing press is the last line of defense, not only in Europe, in Japan, Britain, the United States, the same thing. So the overall trend I see is more balance sheet expansion of central banks, more money printing, more quantitative easing, or in Europe it's called LTRO operations, whatever it is. we will see more of that. I think the interesting point will be at what point the public gets concerned, and I think an interesting point could be if they either get concerned about the banks or more concerned about the banks, or when the market starts to dump some of the so-called safe haven bond markets. If any of the major bond markets come under pressure, I think that could be an interesting point.
Well, yes, I agree with you. And one thing that particularly interests me is that we have got the early signs of some sort of economic recovery in the United States. Now, if that continues, it's only a matter of time before interest rates have to go up. And we're not talking, presumably, about Bernanke's 2014. We will be talking about sometime this year. And if interest rates rise, then that will obviously have the effect on government debt funding costs. And that government deficit is going to balloon outwards. I mean, can you see a solution to that?
No, I can't really see a solution. I mean, I think I'd be very skeptical as to the recovery. I mean, I think I can envision, obviously, a number of months or maybe even a few quarters in which
a statistical recovery.
Yeah, exactly. It will be. It is a manufactured recovery because the Fed expanded their own balance sheet by about $600 billion last year, and they've just before Christmas, obviously, they were engaged in the major swap operations. We already mentioned the ECB injected €1 trillion. We know the Bank of England is the world champion in quantitative easing. They've just done 2 rounds of quantitative easing since October. So there's a lot of money being pumped into the system right now. So I think that should definitely generate some kind of asset market, bubble. I'm still doubtful how much we will see in terms of real economic indicators. With some of that money will trickle into the real economy, so I could see some better data. But I think we all know that over time you will get ever less bang for your buck, and for ever more bucks you will get ever less bang. And I'm curious to see. It will be interesting to see after even these massive interventions from central banks, how much of a synthetic recovery we're going to get. My outlook is it will be rather minuscule and short-lived. So I don't think we will see a sustained recovery that will even force the Fed to tighten. But I think inflation will continue to be sticky at higher levels and potentially rise. So I think we see the recovery will underperform expectations. And I do think inflation will surprise on the upside.
Well, I agree with you entirely on that, because with a policy of trying to replace stagnant or contracting bank credit with raw money, I think the effect will be just to push up prices in money, right, in paper money terms of virtually every commodity. I mean, we're already seeing that in the price of oil, I think. We've yet to see it in the price of gold, perhaps, because gold has been correcting for a little while now. It's been consolidating. And I note what you were saying about public perception. The public are a long way, I think, from seeing, perhaps we ought to have some gold. I don't think we're anywhere near that point. I mean, how do you see it?
No, I think we're not at that point at all. I think the number of people who see gold as a self-defense asset, because that's how I really see it. It's a way for me to defend, protect some of the purchasing power in my savings. It's not. I don't buy gold as any idea of sort of any price goals or anything. It's to maintain the purchasing power of my savings. And I think so. Gold in this scenario is the essential self-defense asset. And I think the number of people who realize that is growing, but it's still a minority. And if you see in terms of the share that gold has in terms of investment portfolios, or certainly among institutional clients, for example, or pension funds, or insurance companies, is minuscule, if non-existent. So I think there's a long way to go. But I think things can change fairly quickly. And I think at this stage of the crisis now, a lot about how things are going to unfold will ultimately depend on public perception. So I think if people start to lose confidence in these government bonds, if pensioners look more closely and realize how many government bonds they hold in their pension funds or insurance portfolios, and then also realize that the marginal buyer of all these bonds right now is simply the Bank of England, which is, or whatever central bank it is. I mean, around the world now, the largest buyers of government bonds on the margin are central banks, which sounds like Weimar Republic all over again. If that more and more people realize this. I think behavior will change. And then I think we reach another stage in the crisis, because a lot of what policymakers get away with right now is only possible because there is still so much confidence, or maybe you call it complacency out there. And just sort of, in the speech earlier today, I called it normalcy bias, which is the idea that, because the system we live in right now has operated for such a long time, bad things won't happen. And I think there will be a change. But we are early in that process. I agree with you. I don't think most people think that the banks are safe, that government bonds are safe, and that we are somehow on the road to recovery. But I think that perception can change quickly.
Yes, I think your description of normalcy bias, I think actually is a very, very good summation of it. Detlev, thank you very much indeed for taking just a few moments.
Thank you, Alasdair.
I thoroughly enjoyed it.
Thanks so much. So did I.
Subscribe to the Gold Money newsletter at www.goldmoney.com to receive email updates on new articles, videos, and iTunes podcasts from our Gold Research section. The information contained in this podcast is an expression of opinion and does not constitute investment advice. This is the Gold Money Foundation podcast with Alasdair Macleod, keeping you up to date with expert opinion on precious metals and the markets.
Hello, I'm Alasdair Macleod, and I'm here on behalf of the Gold Money Foundation. And with me I have Detlev Schlichter, who has written a very interesting book called Paper Money Collapse. Welcome, Detlev. It's very nice to have you here.
It's my pleasure. Thank you.
I read your book with great interest, and I must say that I agreed a lot with what you said, almost entirely with what you said. The conclusion is, it seems to me, one that I agree with, and that is that you've got the potential, I think, for crisis first at the end of the day and solution second, as being the ultimate outcome of our paper money. Is that how you see it?
Yes, absolutely. I think what I show with my book is that we cannot really make a fundamental economic case in favor of paper money, of fiat money. And the way I characterize fiat money and distinguish it from commodity money, traditional forms of money like a gold standard, is that in one system, the fiat money system, the supply of money is essentially elastic, and in a commodity money system like a gold standard, the supply of money is inelastic. And what I try to show with my book is that, based on thorough fundamental economic analysis, you can show that elastic forms of money must over time lead to economic imbalances that get ever bigger, that accumulate over time and completely destabilize the system. And I think we've reached such a point now in our system. I think there are two options now, two possibilities how we can deal with the present crisis, which I consider to be a fiat money crisis. Either, we stop voluntarily, or monetary authorities, we will see any political initiative here, any end to money printing, and any end to fiat money expansion.
Of course, what the politicians will do is, in the past, they've been very successful at buying off the inevitable, and they're going to continue to do the same. I suppose, kicking the can down the road is the other way of putting it. But I think what we have seen, and particularly with the banking crisis in 2007-8, was the end of an accumulation of credit-driven cycles, which just got more and more out of control. And your book has a very interesting section on, the effect of paper money and credit on the underlying economy. Would you agree with me that
stop voluntarily printing money and allowing the market to set interest rates, thereby allowing the market to also cleanse the system of accumulated imbalances? So we have to go through a crisis, but one that cleanses the system. Or we don't do this because it's politically not deemed acceptable, and we then have to print ever more money, ever faster, which is what we're doing right now and what I think will continue. But that then also means that we even get a larger crisis at the end of it. So whichever way you look at it, I think a crisis is a certainty. The question is a bad crisis sooner or an even worse crisis later, although we can argue now how much later that is really going to be because we're running out of time. But I think you're right. That my hope is very low that